As we head into June, the Bank of Canada is going to be having their meeting soon, and there's lots of talk of whether they're going to drop their interest rate or keep it the same. And I thought it'd be interesting to chat a little bit about how that might affect interest rates on your mortgage and what that means for you heading into the summer. Hello, this is Cory. If you're like me, when it came time for me to buy my first home, I sat down with my mortgage broker and they gave me all sorts of options as it went for mortgages. They talked about amortization schedules, interest rates, fixed versus variable, and a lot of it didn't make sense to me, but there is a science behind how the bank comes up with those factors. Why don't we start by talking about fixed rate mortgages, as those tend to be the most common type of mortgages that folks get. A fixed rate mortgage is just that. It means that you have a fixed rate across the term of your mortgage. And that term could range anywhere from 1 year to 10 years long. If you were to head into the bank today and say that you wanted a fixed rate mortgage and you wanted to compare, let's say, a 1 year versus a 3 year or a 5 year, you would notice that there's different interest rates attached to all those different terms. Bank of Canada is always assessing how to spend the money that they have to spend, whether they should give it to you as a mortgage or they should spend it on a different type of debt that could actually garner them more interest on that money that they put out there. One thing that most folks don't realize is that a bank will often look to the bond market to see what's happening there to determine what type of interest rate that they're going to charge you. The bond is essentially an offering of debt from a government or a corporation. And for example, it would be the government, let's say, coming to you and saying, will you carry this $1 million worth of debt for me for the next 5 years? And in return, I'll pay you a fixed interest rate every year on top of that $1 million just for holding that debt for me. And then at the end of that 5 years, you get that money back out of that bond. Well, one of the people that will often buy bonds or look at bonds as part of their portfolio is a bank. And what they're looking at is whether they should put their money into a bond with a corporation or the government, or they should offer it out to you as a mortgage. But the banks often consider mortgages riskier than taking on a bond from a corporation or the government. So therefore, they'll put an interest rate premium on top of that mortgage in comparison to the interest rates being offered on bonds. If you want to get a better understanding of what might happen with mortgage interest rates on fixed rate mortgages in the future, then it's worth looking at what's going on in the bond market. And if you really want to get into the weeds on it, then start to understand what a bond yield curve is. Now let's move on to variable rate mortgages, as that is a different product offering from the bank, and the way they determine interest rates on variable rate mortgages is not the same as fixed rate mortgages. Variable rate mortgage is just that. It's a mortgage that has a variable interest rate, meaning that it can change in flux at any time. A bank will determine the interest they're going to charge you on a variable rate mortgage by looking to the Bank of Canada's policy interest rate. Typically, a bank will put a premium on top of that policy interest rate, and they will offer that out to you as their prime rate. If you go to get a variable rate mortgage or even a line of credit, they will tell you that they will offer you prime plus or minus typically a few percentage points or quarter of a percentage point, and that becomes the interest you're being charged on that mortgage. So, as the Bank of Canada adjusts their policy interest rate up or down, it in turn affects your line of credit or your variable rate mortgage. In my 15 years of selling real estate, I don't think I've seen more people pay attention to what the Bank of Canada is doing with their interest rates than right now. And the reason for that is that those interest rates are historically high compared to those last 15 years, and it directly impacts all those variable rate mortgages or lines of credit. And right now, quite a few folks have a lot of debt. Just remember, at the end of the day, the bank's number one objective is to make money, and they make money off lending you money or lending corporations or the government money as well. And that's kind of how all of that works. If you're in a position where you're feeling a little bit strapped or you're uncertain about what the future of your own personal finances look like, including your mortgage, then I would encourage you to sit down with a financial planner or a mortgage broker, or even just somebody from your bank that has a bit more direction than you do when it comes to personal finance. I found at times in my life, having those conversations can often give me the clarity that I need to make the right decisions for my future and just also put my mind at ease. If you've enjoyed this video, I want to thank you for tuning in this long. If you have any questions, leave a comment down below. And we'd also love you to hit that like button. It helps us out. And until next time, have a wonderful day.